Well, Apple has breached $2 trillion in market cap. I remember not too long ago when they broke the record and reached $1 trillion in market cap. And for those of you, who are uninitiated, market cap is short for market capitalization, and it just means the total value of the company if you take the share price right now and multiply it out. Now, obviously, if you tried to sell the whole company on at once, you wouldn't get $2 trillion for it. So it's not the most accurate number in the world, but it's the number that we use to value corporations that are publicly traded. So for all intents and purposes, Apple is now a $2 trillion company. And this to me is an important milestone, not really for Apple computers, but for the American sort of financial farce in general. Because has there been some great news for Apple over the last couple of years that would justify a doubling of its value? No. This story has very little really to do with Apple. And arguably you could say that Apple's position has worsened over the last couple of years. I mean, between the cracks in sort of the infallibility of iPhone sales that we've seen, as Apple has continually raised the prices of iPhones, putting a bit of a dent in sales, as well as, this very uncertain shift from x86 over to ARM-based computer platforms. I mean, from an objective, just normal looking at their business standpoint, I would say that, Apple is much less of a sure bet today than it was a couple years ago. Yet the price of the stock, the value of the company, has doubled. If you look at a chart of Apple's valuation from 1980 when they first went public, adjusted for inflation, and I should try and find the Zero Hedge store because I believe they had this chart. Although I also read a Bloomberg article on it, so I'll have to check which was which. But essentially, Apple stock is totally vertical in recent years. And this really is because, Apple, as well as Amazon and some of these other tech stocks, your FANG stocks, as we used to call them, although I don't hear the term FANG thrown around as much anymore, they have benefited from the fact that there simply is no other alternative at this point. The Fed has forced everyone into stocks. And, when people look at the stock market, trying to chase some yield, what are they going into specifically? Well, they're going into what they see as the highest growth potential sector, and that is all these tech stocks. And so while, the stock market has benefited from just this flood of money from people chasing yields who cannot, really break even in the bond market, who are trying to make, a decent annual return, that whole flood of dollars has really, been channeled most directly into stocks like Apple. And so that's why this $200 trillion market cap milestone for Apple has much more to do with the overall market than it does with Apple itself. And I think looking back, today will be seen as an important date in financial history because in the future, people will look back on this and really question how people just took all this insanity seriously. How is it that more people didn't see the signs that it was completely absurd for Apple's stock, for their market cap to double in just the last couple of years, especially when we're in the middle of a Great Depression? I mean, people forget that things have not gotten better, and they're probably going to get a bit worse. Yet this company that makes high-end consumer electronics is sitting at all-time highs. They're sitting on top of the world. They haven't felt any pain. This just doesn't mesh well with reality. With tens of millions of people unemployed, is that really going to help iPhone sales? Is that really going to help, the sales of Macintosh computers, which are incredibly overpriced, in my opinion, and, many other consumers' opinions? And the answer that any reasonable person would give would be, of course not. And so Apple's stock right now, because it has gone up so much more than the overall market, Apple stock in particular might be one of the biggest bubbles. Now, you could argue certainly that Tesla and some of these other tech stocks are bigger bubbles, but I mean, just looking at the sheer size of Apple's market cap, and you think about just how much hot air there is. I mean, just looking at the chart, how much hot air there is. And then you hear someone like the Fed's, Jim Bullard, I believe he's the president of the St. Louis Fed. He came out and said the stock market, it's doing about right. Meaning the stock market, it's not overvalued or anything. There's no bubble in the stock market. The stock market's right where it should be during, the second Great Depression, right at all-time highs. Remember that little correction we had a few months back in like March? Yeah, that was just a blip. We're already, not only have we completely gone straight up with no correction since then, straight up back to where we were before, but we've overcome that. We've gotten to all-time highs again, new all-time highs. The economy, if you listen to the stock market, is now stronger than ever, even though we still have tens of millions of people unemployed. And even the official unemployment rate in this country is still double digits. And so my response to Mr. Bullard would be that the stock market is not where it should be. The stock market is exactly where you at the Fed put it. It's not where it should be. It's where you want it to be. In a normal market economy, the stocks of companies that operate, in that economy, their price should, reflect really the state of the overall economy. People forget that stock market growth, in theory, should be equivalent to GDP growth. U.S. GDP is pretty much flatlined since 2008, yet, U.S. stock prices have gone to the moon. And, the scariest part is that all else equal, the Fed really could keep this up forever. If all the Fed wanted to do was pump money into the stock market and keep stocks going up for eternity, they could do that. The problem is that the Fed will and is ultimately having to print money not just to put into stocks, but to put into other markets to try and keep interest rates down across the entire economy, to buy up all of this excess U.S. government debt. You see, right now tax revenues are quite slim, yet the expenses of the government, since they're doing so much to try and bail out everyone and everything in America, the government has a lot of expenses. And so somebody's got to pick up the tab. And, were the government just to dump all these bonds out into the open market across the world, the rest of the world's hurting pretty hard too, so it would probably be hard to scrounge up all these funds, which means that interest rates likely would rise. And we know that that simply can't happen since with, $20-something trillion in debt, the U.S. federal government can't afford really to pay any interest rate. They have to pay near zero in order just to, service their debt, let alone ever pay it off, which will never happen. And so the Fed has had to step in to buy up all this debt and to essentially directly inject dollars into the U.S. economy. And in doing so, they're not just dumping money into the stock market where it doesn't really affect anything except the price of stocks. What they're doing is dumping money into the economy to where it can get into the hands of consumers and actually, affect inflation. And so, without getting into the very convoluted way in which monetary policy and sort of, well, let's say the transmission channels of monetary policy, without getting into a deep discussion of that, what essentially you're going to see, in my opinion, the way that the stock market is going to come undone, the way that all these excesses will be purged, is that it is because of the Fed monetizing the government debt that we will finally see the beginnings of an uptick in consumer price inflation. And as that happens, we will see a natural rise in interest rates. Because baked into the interest rate is always the inflation premium. That is that in order to have a positive interest rate in real terms, the interest rate must be some percentage higher than whatever the inflation rate is. And so naturally, if the rate of inflation goes up, well, then the nominal interest rates are going to have to rise. And this will increase costs for a lot of these heavily indebted corporations that are publicly traded in the stock market. A lot of these companies that are sort of the stars of Wall Street, if the costs of servicing their debt, if the cost of, issuing debt goes up, well, then that is going to be something that will very quickly pop the bubble. Now, that doesn't mean that there won't be some kind of technical pullback in the stock market. Of course, there will be. That is a natural danger when you hit all-time highs, is that there is a pullback, and that's a psychological phenomenon when it comes to exchange-traded markets. But I do think that, in theory, the Fed can defeat that and overcome it, because the Fed really, in a vacuum again, can do whatever they want with the price of stocks in the long run. But it is when if and when we start to see this uptick in inflation, that is when it will really be scary to hold any stocks, in my opinion. For now, the way that this farce has gone on, there's not much that I think else that can happen that will break investors out of their trance. So with that said, if you gained anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.